Hey, good morning, everybody, and welcome to this Wednesday, March 6th, 2024 edition of Trading Places Live. At
Hey, Tom.
Yes.
Can you move your mic a little bit closer?
Oh.
Sounds some echo.
Yep. One thing I didn't do this morning. Okay, there we go. But anyway, welcome this morning to this edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at EarningsBeats. And I'll be your host for the next 30 minutes or so as we prepare for another day of trading. And this morning, kind of interesting. Now we got Fed Chief Powell coming out and saying, well, rates likely have reached their peak and we can look forward to some lower rates down the road. So now we're going to go that way. And of course, futures pick back up again. So as the Fed chief moves back and forth, the market moves up and down. And that's what we've come to expect from this Fed for probably the last 2, 3, 4 years. I mean, seems to never end. Just depends on which side of the bed he seems to wake up in the morning on. And that seems to dictate his policy for that day. But today it's all about rate cuts. And so now we got futures going back up. We've got Dow and or really all of the major indices up in the neighborhood of about 0.5% up to about 1 full percentage point. So it does look like we're going to get off to another pretty good start this morning. And this comes on the heels of some selling that we saw yesterday, probably the most selling that we've seen just about at any point this year so far. And I'll show you a little perspective on that a little bit later in the show. We'll kind of wrap up with that segment at the end. But yeah, I mean, there's been a lot of, a lot that we've had to look forward to in terms of interest rates, being cut, but it seems like it's kind of been going all over the place. And anyway, I just feel like, now is the time for the market. If it is going to pull back, this would seem to be the time to do it. I mean, we've had continuing run to the upside. March is historically not a great period. First week of March isn't bad, and that's kind of what we've been through so far. But the worst part of March tends to be around the 6th to about the 10th. Today's the 6th. The 10th would be what, over the weekend maybe. So maybe through Friday or maybe even next Monday. I'm just giving you historical terms. I'm not saying that's a prediction. I don't know when the market's going to pull back or if it's going to pull back. I've said all along, I'm pretty bullish. I've been bullish and I'm continuing to be bullish. I think prices continue to go higher for a couple more years. And I know that's a lengthy forecast, but, we'll have some pullbacks and maybe we'll get signals of a correction somewhere down the road. But right now, my signals say it's full speed ahead. Market looks good. And I'm going to continue to look at the bullish side of things while others try and tear the market apart. Let me go ahead and get started with the recap from yesterday, Tuesday's action. Dow Jones Industrial Average down 404 points. That was down over 1% yesterday. S&P 500 also down slightly over 1%, dropping 52 points, back below the 5,100 level, closing at 5,078. And we got the NASDAQ 100 dropping 329 points, 1.8%. That was a big drop and a type of drop that we really haven't seen much of in 2024. And so I was wondering maybe, is this it? Is this where we maybe go down, break through the 20-day moving averages, maybe get a 50-day test? Because we haven't had one of those since, at least here on the NASDAQ, we haven't seen one since we broke out above the 50-day back at the beginning of November. So we've gone below the 20 a couple of times, but we've yet to even sniff that 50-day moving average. Mid caps down 9, so that was down about 1/3 of 1%. IWM, which is the ETF that tracks the Russell 2000, the small cap index, that was down $2 or almost 1 full percentage point. But both mid caps and small caps outperformed their larger counterparts and did so in the case of mid caps by a pretty wide margin, losing just 1/3 of 1% there. And I was talking, may have been yesterday's show, about mid caps and how really bullish that group has been. I mean, small caps look good to me. Mid caps have been even outperforming the small caps as this wave of rotation has taken place in 2024. A lot of money rotating into the mid caps these days. And yesterday, when we had a chance for some selling in that area, still really didn't see much. So mid caps remain very strong on a relative basis. Transport's down more than 1%. So falling all the way back down to 15.6 and change. I've said maybe 15.4 is a level to watch in the near term. 15.2 is the ultimate level, I believe, on the transports. We don't want to lose that level. I don't think we will, but they certainly haven't been performing very well on a relative basis. And so we'll continue to watch those key support levels there. Leading yesterday, of course, with the market moving lower, what would you expect to lead? I would not be expecting, technology, discretionary, communication services, and it's a good thing because they weren't up there. The leaders, energy rising 0.75%, staples up 0.25%, and financials flat. Financials have been really one of our strongest performers in 2024. And even during the sell-off, not really seeing much selling in the financial space. Moving on to the industry groups, fixed line communications, which is a little bit more of a defensive area, rising 2%, a little over 2%, back over 100, 101.79, and breaking to about a 1-month high. So we did see a little bit of technical improvement in the chart on the DJUSFC. Renewable energy, again, challenging about a 6-7 week high. Up over that 300 level intraday yesterday, but it did close at 298, still finishing up 1.5% though. Watch, this is a group that can really move fast. I'm watching this 305, 307 area, seeing if we can get through. That would be a good sign for the renewable energy space, at least in the near term. Could be a push up toward the 330 level. And from 305 to 330, I mean, we're talking about maybe 7-8%. And if the index does that, we could see some of those individual names maybe do even better. Got to get that short-term breakout first. Banks. Look at the banks going up, setting new highs. Volume's been strong. Look at this AD line. I've talked about the banks having a really good year this year. Apparently, I'm not the only one thinking that, because the AD line suggests there is a ton of accumulation taking place in banks. I've said before, when rates go up and you get an inverted yield curve, the area of the market that is most impacted from a negative perspective is banks. When they get there, when the yield inverts, all of a sudden their net interest margins get squeezed. And I audited banks for many years when I was in public accounting. The inverted yield curve hurts banks first. And then the question becomes, how strong is the economy? Because if the economy is weak, along with the inverted yield curve, that can be a lot of problems for the overall market. And the reason is that if the economy is weak, banks start to see loan losses mount. And if you have the combination of loan losses mounting and your net interest margin squeezing, that is an awful environment for banks. And what it does is it impacts their lending. A lot of banks, at least banks that I've worked with, folks that I've known in the banking industry, tend to be pretty conservative. And when they start losing money from shrinking interest margins and rising loan losses, they stop lending. They will not lend. I mean, you have to promise your first 5 children to get a loan from a bank. And so the problem with this market, not really problem, but the difference with this market is that the economy has remained strong. It's been very resilient. So even though net interest margins have been squeezing, banks are still lending. And that's the big difference that's keeping this market afloat. As long as the economy remains strong, and then we start seeing this inverted yield curve reverse, now all of a sudden banks' margins start doing this. And when they start doing that, first of all, the market's not going to wait for that to happen. The market anticipates. So the reason, in my opinion, that you're seeing all of this accumulation in the banks right now is because Wall Street, the big firms, are looking ahead and they're seeing an environment where banks' profits are going to grow and probably grow rapidly. They're getting in now. They'll tell you about it at the end of the year, but they're getting in, and they've been getting in for the last several months, especially the last 2 or 3 months. So this is I believe, the preparation for a much bigger advance potentially in banks later in the year. I've said I love banks. I think banks are going to do really well. Also, keep in mind that regional banks, the small to mid-sized banks, are one of the largest areas within the IWM. That and biotech are, I think they account for probably 15% or so of the IWM. So that's another reason why I like the small caps and I like the IWM, is because as the rates come back down, first of all, it's going to trigger biotechs. Anytime you got cheaper money coming, that's usually a good thing for an aggressive area like biotechs, likes to do a lot of research and so forth. So I think you're seeing some of that start in terms of biotechs doing better. But the banks really doing well in this market. Yesterday, even with the big sell-off, banks up 1.5% almost. So continue to keep these on your radar. I think banks look good for 2024. I think that they were beaten down heading into this year, or at least, through much of last year. And as a result, there wasn't a whole lot of expectation out of the group. And now that we've kind of gotten to the end of the rate hiking cycle, and the Fed, of course, they keep going back and forth, but I think most of us know there are rate cuts coming. And as we start seeing those short-term interest rates fall, the Fed funds rate fall, you're going to see that inverted yield curve begin to switch and flip back to the upside. And that will be, with a strong economy, that's only going to add to what's going to be working for banks for probably the balance of this year and maybe into the next year or two. Remember, this is a group that hasn't done well for about 15 years, going back to the financial crisis in the late 2000s, 2008, 2009. So this is a group that could be poised for a pretty significant rally and actually show leadership. Usually the only thing I look for banks for is just go along for the ride. I just want them to remain kind of, if the S&P goes up 10%, I'd like to see the banks go up 10%. Just be there to support the areas of the market that are going to need banks. And so they've been doing that, but I think we could actually see outperformance from that banking group later this year and into 2025. All right, moving on. Let's keep going. 10-year Treasury yield. So yield is broken back down below 420. Three of the last 4 days now, we've closed below that 420 level. I wouldn't exactly say we're in a downtrend. I would just say that maybe this breakout has now become a little bit of a false breakout, and that we're more into sideways consolidation. I would not really say that we're in a confirmed downtrend, especially in an intermediate confirmed downtrend, until we take out that low from December, which is just below 380. Right now, 4.125, so 4.13%. And that 50-day moving average coming up pretty quickly right now at 4.11%. So 10-year Treasury yield, interesting. This morning, ADP employment report came out. That's the other thing that I thought was kind of a 1-2 punch this morning. We had the Fed talking about, now they're back on the side of talking about rate cuts. And you've got the ADP employment report coming in this morning just a little bit below expectations, which I think is nirvana. Because I think the expectation was 150,000, came in at 140. I like it coming in positive, but lower than expected, because it's telling us the economy still remains strong, but it's not overheating. It's not something that we would worry about that might not, it's not the kind of gains in jobs that, in my opinion, would have the Fed rethinking rate cuts. They're still all on board with rate cuts. As long as the inflation remains low and job growth remains modest, I think this is nirvana for stocks. I really do. I think market keeps going higher. Now, again, I'm going to show you some perspective later. You need to expect from time to time there's going to be a pullback. But I had people back in November when I was saying, hey, this is great. Market's going back up. We're resuming our uptrend. And people were saying, why talk about getting in when the market's at a top? It's been going up. Why would you get in now? Well, I mean, look at a 100-year chart on the S&P 500 and tell me during a secular bull market why you wouldn't want to be in. And if you look at the history of these bull markets, they can go on for 20 years. So are you literally going to wonder about whether we're 5% or 3% or 6% over extended? You want to be in during secular bull market advances. That's the key. And to the extent you can be out during any type of bear market, whether it's cyclical or secular, that's just going to boost your return over the long term. Remember, 9% a year is average on the S&P 500. That's the average, all bull market years, all bear market years, and that's diversified S&P 500. I don't want 9% a year. Over time, I want a lot more than 9% a year. First of all, I think I can pick better stocks than the S&P 500 has in it. That's number one. And number two, the market, you've got areas like technology that almost always outperform the S&P 500 during market advances. So if I believe the market's going up, I want to be overweighted in technology stocks. And that historically has proven to be one way to significantly outperform the S&P 500. Anyway, speaking of the S&P 500, here was the move down yesterday. I mean, going up, you had a down day here, you had a down day here. There was a down day. What's that old McDonald? Here a down day, there a down day, everywhere a down day. But that's been the kind of all we've seen in the last 4 to 5 months is just this one day move to the downside, and then the market picks right back up again. We're at some point we're going to have more than that. I think we all know that. The only year I can think of that avoided any type of significant pullback at all was 2017. And I think we went something like 500 days without more than a 3% decline. I think it was 2017 into 2018, or maybe late 2016 through early 2018, something like that. But there was almost no volatility. It was just day after day after day, boring action, just continuing to go higher. Just leave your money parked and just let it ride. This has been kind of similar. The only thing I would say here is that the slope of this advance, I mean, from 4,100 to 5,100 in literally just over 4 months is too much. 25% every 4 or 5 months. I mean, you can for a while, but it's not going to last. That's too much. So, you almost I want a healthy pullback from time to time, just because the longer you stay in a channel that cannot sustain itself, the harder the fall when we finally get one. So even if we don't have a big fall, it'd just be nice maybe to have an extended period of consolidation. But anyway, right now, S&P 500 wants none of that. NASDAQ 100, same thing. Yesterday, pretty big drop above the 20-day, but look at the intraday low. First of all, 20-day EMA, 17,832. Yesterday's low, 17,804. We actually went below the 20-day moving average. And by my count, it's probably only maybe about the 6th or 7th day. Let's see, it's 4, 5, 6, 7. Actually, it was the 8th day this year where we had an intraday low or closing low below the 20-day moving average. Hasn't happened often. I mean, we're in our 3rd month now. So anyway, selling was nice. It was warranted. I mean, obviously, we've been overbought for a while. A little sideways action wouldn't be bad. But again, with Fed comments this morning and with a pretty tame ADP employment report, we've got futures doing pretty well this morning. All right, IWM down the last couple of days. I mean, it had a breakout. That 207.5 area where we went to, or even a little bit above, that's the highest level the IWM has seen in quite a while. So if we go back, say, 3 years, I mean, last time we hit 207, above 207.50 was at the beginning of the cyclical bear market back in 2022. So it'd been over 2 years, probably about 26 months since we got to that level. So that's good news. We're trending up. PPO coming off the center line looks good. I think bullish momentum is strong. Watch the rising 20-day. If we happen to get down to the 201 level on the IWM, I think that's a strong buy. Based on everything I'm seeing in the market, I think it's a strong buy. Even if the market pulls back more in March, the major indices like the S&P and the NASDAQ, I think that money could rotate just like we've been seeing into the small caps. I wouldn't be surprised. So I personally will be surprised if we lose 201 on the IWM on a closing basis, not intraday. So we'll see. Let's see. Take a look at the transports. There's the transports just kind of going sideways here in this range. Really nothing more to add. It's been kind of boring. Moving on to the chart of the day. First, if you are new to EarningsBeats, if you're new to the show, if you go over to EarningsBeats.com, you'll probably find some things maybe you're interested in. Number one, you can start a 30-day no-cost trial with us at any time if you're not already a member. That does require a credit card. You have to provide us your credit card so we can get you set up in our system. But 30 days, no cost, and we'll remind you before your 30-day trial expires. So we're not just going to sit back. I know I've been in services before where they don't tell you that your month is up and they just charge you. We will absolutely reach out to you, let you know that your 30-day trial is over or going to be ending. And we don't want you paying if you don't feel like our service is valuable to you. But if you do join 30-day trial, or if you're already an existing member, you know Wednesdays, that's our live trading room. So at 10 a.m., we say 45 minutes, and I'm going to try to hold it to 45 minutes today. I got a lot going on. But last week I did an hour and 45 minutes. I mean, I provide a lot of value in these rooms, trying to provide education. I try to talk a lot about how we approach the market at EarningsBeats, so you understand the products that we offer, the various chart lists. We try to go over. I'm going to spend some more time today talking more and more about that, about how our chart list can help organize things and what they mean and how you can run scans against them to quickly identify great trading candidates. So make sure you join us today for that live trading room. If you scroll down further, if you just want to learn a little bit more about us, you're not ready to take that step for the paid service and the 30-day free trial, sign up to our free EarningsBeats Digest. This is designed to we just want a big reach out there into the investment community. We want to teach. I think that these EB Digest articles are very educational in nature. Some of them are great, ideas for potential trades. Of course, we simply ask anyone who uses those trades to make sure that they're comfortable with the risk and so forth. We are not registered investment advisors. I like to point that out often. So I'm not licensed to provide advice or recommendations. I don't even like those two words. We provide education. And that's part of what we do in terms of educating is have this EarningsBeats Digest article published 3 times a week, Mondays, Wednesdays, and Fridays, usually before the market opens. I try to do it before the market opens, not always, but most of the time, I would say. And all it takes, name and email address, no credit card required. And once you've subscribed, you can unsubscribe at any time. I can tell you, I know most free newsletters kind of wear off. They're probably much more marketing than they are content. I'm not going to say we're not marketing. We do market, but there's a lot to our content that we provide on this EarningsBeats Digest newsletter. And if at some point you feel like, hey, I'm not really getting anything out of this, this isn't my style, whatever, unsubscribe. No hard feelings. We're just trying to do our part with the community and help reach out and teach. But if for whatever reason it doesn't work out for you, that's fine. But I can tell you that most of the folks that sign up to this newsletter continue to open it pretty much every time we send one out. It's that valuable. So make sure you give it a shot. Tens of thousands of people have signed up for our EB Digest. So this is not just a little, 20 people, getting involved and trying to learn a little bit about the market. I mean, this is a big deal. So make sure you sign up 3 times a week. You'll be getting some great education, possibly some good trading ideas. I look at the market. I look at sentiment. I talk about sentiment, some of the things that help drive my decisions on where I think the market's going. Some of those signals are in our free EB Digest. So make sure you check that out. Anyhow, let's keep moving on to the chart of the day. So this is one that ACM Research. I really like the small mid caps right now. And this is one that absolutely exploded with its earnings. You can see the huge move up. I'll show you the daily chart in just a minute so you can see the actual day of earnings. But this was the weekly. Look, this was the highest volume week in the stock's history when it went up, made this huge move. So that's a pretty good sign that there's a lot of folks interested in this stock for the long haul. It's only about a $1.8 billion company. And that might seem like a lot since I'm saying billion, but to put it into context, I mean, we've got $2 and $3 trillion companies. We've got many, many companies, hundreds of billions. So when I say 1.8 billion, it's actually a very small company relative to what we see typically throughout our major indices. So I like the small caps. I think these provide great opportunities for upside, but small caps carry higher risk. They're smaller. They're easier for, sometimes competition comes in, their product looks good for maybe a quarter or two, and then somebody comes out with a better product or better marketing or better something or other, or maybe one of the big companies comes out with a product that competes and just completely blows them out of the water. It's hard for small caps to do well in this environment when large caps are doing so well. But it seems like that rotation is changing. And if I'm right and small caps are going to do well for the next year or two, stocks like ACMR could be really big winners. So I think it's okay to sprinkle some small caps into your portfolio from time to time. And this is one that I think is really starting to look good. I mean, I even see off of this move to the downside, I see a left shoulder, neckline, head, right side of the neckline, and then the shoulder, and then boom to the upside. Hold on one second. So anyway, ACMR I think looks pretty good. Now let's take a look at a daily chart. So I can show you this volume. This is a Marubozu candle. If you're not familiar with a Marubozu candle, it's a candle that opens on its low and finishes on its high. Basically, there's a little bit, it looks like the intraday high was a little bit above the close that particular day, but this is a massive bullish candle. And look at the volume, 12 million, over 12 million shares to accompany this Marubozu candle. That is as bullish as a candlestick gets. I cannot think of any candle that I would rather see on a chart than that one. So if we go back on this daily chart and we look back several years, let's go back 7 years, you will see how many days trading 12 million shares. I count 0. I count only one day where we were over 8 million shares prior to last week's earnings. And so I'm looking at this thinking, give me a pullback. Anything close to where we opened, and that was at 25.20. I mean, anything, I would be working into a position on any weakness, to be honest. That's me, and that's being aggressive. But I really like this candidate. I wanted to feature small caps this week in our EarningsBeats digest. So I featured JFrog, ticker symbol FROG. Let me show you this stock because I said it would be best if we could get this stock somewhere between 40 and 41. Yesterday, oops, don't want that. Just want the daily. Yesterday, we got down to a low of 40.68, and I put this out on Monday when the stock was around $45. In 2 days, we've gotten that 10% pullback to the 40.41 level. And now, I don't know, this one, to me, it looks like it could go. Maybe we get down into this. I mean, it could go touch into the 39s. I don't know. I mean, you got gap support all the way down 37. You can make all kinds of different arguments. I just think, again, with this kind of volume moving to the upside, I don't think the selling is going to last long. And so I thought this area right here, prior high just above 40, this low right around 40, I thought 40 to 41 was a pretty good area. And it's trying to rebound off that. We'll see what happens today and the rest of the week and next week and so forth. But then you've got ACMR, and I'm kind of, this one kept going up with high volume the next 2 days as well. It would be wonderful to see 25.20. I don't know if we'll see that, but notice that rising 20-day moving average is creeping up under that 25 level as well. So this is going to be a really big area of support. And the closer you get down to it, the better the reward to risk on a trade becomes. Because if you've got a stock down around 25.5, and you've got, just fractional maybe 50 cents or $1 risk, and you've got $8 or $9 to the upside, that's an 8-to-1 reward to risk ratio. That means if you hit, one stock, with this type of setup, if you're correct on 1 out of 9, you'll break even. If the other 8, you lose $1. So you lose $8 on 8 trades. And then on this one, it turns out to be right. All it takes, when you get reward to risk of 8-to-1, you only have to hit 1 out of 9 to break even. I like those odds. And if you happen to hit half, you're going to make a fortune. That's why managing risk and understanding reward to risk in trading is so important. All right, one last thing, and this is what I wanted to show you. Actually, that is not what I wanted to show you there, but let me pull up the QQQ. Try maybe. There it is. Good, I don't have to show it. I didn't want to have to recreate. Anyway, QQQ. Here's the year-to-date chart on the NASDAQ 100, or the ETF that tracks the NASDAQ 100. And what I did down here at the bottom is I put in a 1-day rate of change, a 3-day rate of change, a 5-day rate of change, and a 10-day rate of change. And then, just to see what kind of pullbacks we've had so far in 2024. Well, yesterday we dropped over 1 3/4% on the QQQ. And if you look, there's only been one day this year that has been a worse day in terms of how much we sold off. And that was back on the 31st of January when we had the gap down and the sell-off. I would argue, though, that the actual selling here intraday was higher on a percentage basis than either of these 2 days. So I would argue that yesterday's selling was the worst day we've had of 2024, even though it wasn't quite in terms of percentage. Look at the volume pick up there as well, similar to the 31st. Big volume all of a sudden picking up. And the market usually sells off on more volume than it goes up on. Panic is more of a real thing than greed. Greed's a real thing. But when you're greedy, you just don't sell, you hold on. So market keeps going up and you just hold. There's not really a whole lot of volume increase. But when you start selling off, people panic. And everybody's talking about, the market's going to pull back. We're going to have another big correction, or even worse, a bear market, or even a secular bear market. Oh my gosh. We got the Hindenburg Omen. We got all kinds of stuff going on. Well, as soon as you get one big day of selling, there are people out there that just, start to panic. I don't know that I would be in that camp at this point, although, moving to more defensive stocks, I think, I've said that for a few weeks now, really back since the middle of February, that being a little bit less risky, it probably makes sense till we get through at least first half of March, maybe, because historically that's when we know we need to be a little careful. 3-day. So now the last 3 days we're down about 0.75%. Well, you can see here we were down 3.25, a couple times close to 2%. Again, that's the extent of it in this year so far. 5-day rate of change. There's 3.5%. Here's 2%. Our 5-day right now is just barely negative. And then 10-day, back February 20th, 21st, right here is the only time really we've gone negative at all, down to 0.5%. I mean, 26th of February, we were showing a very slight negative 10-day rate of change. But look at where we are here. We're still plus 2%. We're 2% higher than we were 10 trading days ago. So not really much of a sell-off. Now what I want you to do is I want you to look at this chart when I add 2 more years to it. Or let's even go back 3 years. Let's go to 2021. And now here's our chart. But now let's look at what the 1 day can look like. Now, during a cyclical bear market in 2022, we had a day here, we were down 5.5%. We had a few other days over 4.5%, 4, many times 3% during this period. You look during the bull market of 2023, we never had a day that was down more than 2.5%. So, I mean, there you can already see the difference between being in a bull market versus being in a bear market. You don't have, it's just much, much less frequent that you see these big sell-offs. So that ought to put your mind at ease somewhat. That it just to lose more than 2.5% in a day would be very odd in the market we're in right now. Whereas when you're in a bear market, that can happen quite frequently. 2021, we were going up. We did have a maybe right here, a couple of days right around 3 to 3.5%. But for the most part, 2.5% prior to the cyclical bear market. Again, 2 and 2.5% was kind of the norm as the kind of the bad days, the really bad days. And yesterday, down 1.78%. So just putting it in perspective, yesterday was a pretty bad day for a bull market, but it's going to happen from time to time. Can't guard against it. The beauty, though, is that you don't see a lot of bunches here where you go down 2%, another 2%, another 2%, another 2%. You go down 2%, you bounce back. That's what history has been. So yesterday, down 2%. Today, already 1%. Market just opened 5 minutes ago. So you can see we're doing what we typically do during a secular bull market. You have a bad day and you tend to bounce right back. It would be nice if, like I said, if we maybe don't go back and set a new high and maybe at least just consolidate for a little bit before we start heading toward the next pre-earnings run, because I think the next one's going to be a big one too. I think rates coming down. I think forecasts are probably going to go up. I would not be short this market. Let the market tell you. I mean, you've been trading above the 20 and the 50-day moving averages for over 4 months. At least allow a break of the 50-day before you even start to think anything bearish. That just kind of makes sense to me. I mean, what's our number one indicator? Price and volume. I mean, that's number one. Unless you've got an overwhelming number of signals underneath the surface suggesting that we are at or near a major top, which I have 0 of those technically. What I look at right now, I don't have anything other than maybe a daily negative divergence. But daily negative divergences many times are nothing more than just slowing movement to the upside or maybe a little bit of consolidation. I mean, the PPO is only at 1, doesn't have to go very far to have a reset. That's a little different than here when we had a negative divergence back in July. I mean, we had sentiment issues. We had some other issues as well. But here we had a negative divergence, and at least the PPOs were 3 and then 2. Here it's 2 and 1. We don't even have that much bullish momentum, is what I'm saying. And you might think, well, how can that be? Well, I mean, when you look at it, the part of it is because the longer term moving average is moving up because we've been going up for a while. So when the long term moving average is going up and the short term moving average is going up, the difference between the two, when it's steady like this, doesn't really change much. And that's what we're seeing here with the PPO. Anyway, but when you look down here and you look at the 3-day and the 5-day, here's a 3-day. During a bull market, you can get as low as, or we have gotten as low as 4% down on the QQQ. S&P would be even more. QQQ's been a better performer. The 5-day moving average, we've seen 5%, 4% on multiple occasions. And you go to a 10-day and we had 7%, 5%, 5%, 4%. So this is what I look at when I say, well, maybe we'll see a 4 to 6, maybe 7% pullback. A lot of what I'm doing is just simply looking at perspective and history and what typically happens during bull market advances. Look over here. This low was probably close to 8%. This one over 10 days was probably about 5.5%. This was maybe 4%. But you can see during bull markets, they don't go down as much. Anybody looking for a really big move to the downside, you're still in fantasy land thinking you're in a bear market. There's a 14%er, there's a 12%er, 11.5, 11.5. There's, close to 10, 9.5. That's where you see bigger sell-offs over 10-day periods when you're in a weak market. You don't typically see it in a strong market. Anyway, let's see what the market is doing, and we'll wrap up. Remember, the live trading room starts in about 20 minutes. So we've gone a little long here on the show. But good action today. We've got the Dow right now up 0.4%, S&P up 0.5%, The NASDAQ up 0.75%. Small caps actually look like maybe they've come back down. Let's look at it real quick on a 5-day, 10-minute chart. So we are off of the open there. I'm just looking right here at this candle, black candle. So we were up earlier. The spider up, coming back down a little bit. QQQ up, coming back down a little bit. IWM. Now, part of what I look at too is just relative to where we've been over the last few days. So you can see the IWM was above yesterday's high that we saw around 10 a.m. So we do have a higher high in on the IWM. If we look at the QQQ, though, you'll see here the high was over 441. Today's high was actually slightly lower. I know it's just, just pennies, but it's just kind of giving you that feel that the IWM remains more in charge, at least in the very near term. And so let's see that change. Until it changes, I think you want to, favor the small cap, mid cap area. But anyway, that's it for me. So in 19 minutes, live trading room starts. Would love to have you join us today. It's free, 30-day free trial, and you'll get the next 5 live trading sessions. Next 5 Wednesdays would all be part of your 30-day trial. Anyway, love to see you there. Members, get ready. 20 minutes, we'll get started. I do want to try and keep it to 45 minutes. I know I say that every week. I'm going to try and do it today. Yeah, see you there. So 20 minutes, be ready. Have a great day, everybody. Happy trading.